Should you worry about manager drift in managed futures strategies? Imagine investing in a fund that promises to follow a specific trading style, but over time, the manager starts making unexpected changes. That's what manager drift is all about. It happens when a fund manager shifts away from the original strategy described in the fund's documents. In managed futures strategies, which involve systematic trading of futures contracts across commodities, currencies, bonds, and stocks, this can be a concern. These strategies usually relying on algorithms or models to spot trends and follow rules, making them less prone to drift than discretionary funds. But drift can still happen if the manager alters the models, changes how much they invest in certain markets, or tries new trading methods without telling investors. Managed futures funds aim to capture price trends and risk premiums in commodity markets and other asset classes. If a manager drifts from the original plan, the fund might no longer focus on the intended commodity exposure or trend-following approach. This could reduce the fund's ability to benefit from market trends or expose investors to unexpected risks. For investors, it's important to review the fund's offering documents to see how much flexibility the manager has. Some funds include broad language that allows for adjustments, which can be fine if you trust the manager's judgment. Monitoring the fund's holdings and risk metrics regularly is also a good idea. If you notice big deviations from the stated strategy or unusual risk levels, it might be a sign of drift. Comparing the fund's performance to relevant benchmarks or peer groups can help spot inconsistencies. Transparency from the manager about any major changes is key. If they communicate strategy shifts clearly, it's easier to understand what's happening. Overall, because managed futures strategies are usually rules-based and systematic, the risk of significant drift is lower than in discretionary strategies. Still, it's wise to stay vigilant. Doing due diligence before investing and keeping an eye on the fund's ongoing performance and disclosures can help you spot drift early. If drift occurs without proper disclosure, it could impact the fund's ability to deliver the expected commodity exposure and trend-following benefits. Being aware and proactive can help you protect your investment and ensure it aligns with your goals.